Today on Deal Sorcery, we're joined by Chris Reilly, Managing Director at VRA Partners, a boutique investment bank based in Atlanta, exactly the type of bank that many private equity firms are trying to build relationships with. Chris is in a unique role where he leads VRA's in-house origination practice, which means he's responsible for building relationships and channels that generate engagements for the firm, from strategic referral partners to sponsor coverage to direct outreach. In this episode, Chris gives us a view from the other side of the table, breaking down how he thinks about buyers, what gets a private equity firm on the radar, and how sourcing works in a sell-side environment. Thanks for tuning in. This is Deal Sorcery. The following discussion is for informational purposes only and should not be construed as investment banking advice or a solicitation to buy or sell any securities or engage advisory services.
So Chris, welcome to the show.
Yeah, thank you. Great to be here, Dan and Matt. Appreciate you having me.
Absolutely, man. So look, you went from big four accounting audits to India-based like growth capital and then family office. Like, what did those chapters teach you about finding deals versus executing on them?
So very non-traditional path to investment banking. I did start my career as an accountant doing big four audit with E&Y. Most of that was with publicly traded companies. Eventually early on knew that wasn't my long-term path, but, had great experience there, worked on a number of different industries and different markets, and then went to work for a large chemical manufacturer, actually traveling a bunch, which was a goal of mine personally to do that. 3 kids, pre-wife, was able to see the world while doing work, which was a great experience. And then, knew I wanted to go back and somewhat differentiate my accounting background and did that by getting my MBA at Emory while simultaneously working at a couple of different startups. Both of those were VC-backed businesses, so got exposure to the private markets through those experiences and then school at Emory. And the cherry on the top before graduating was getting the internship opportunity to work at a large growth equity fund headquartered in Mumbai, doing investing in kind of the Southeast Asia region, which was great experience from an investing perspective, albeit short. So I lived for a summer in India and then moved back and graduated. And that's when I got to go work with my former partner doing private direct deals in a more or less a family office model on the principal side of the private markets, doing direct deals. So deal by deal basis, working with our family relationships to finance those deals. And through that experience, really kind of found a calling in sourcing. And at that point in my career, I had just gotten married. We started to have family. I was looking for a little bit of a larger platform relative to what we were doing, although I liked the principal side of the private markets and was introduced through a recruiting source to VRA. And initially was not inclined to do investment banking, but met the team, learned about the objective for the role and the functionality and how that lined up really well with what I had kind of learned to love. And it was a pretty quick marriage. And, 10 years later, I'm still there and now just made partner. So,
oh, congrats, man. That's awesome.
Chris, your focus is on originations and relationships. When did you realize you were more of a relationship builder than traditional banker or investor?
During my time post MBA in working the family office, really found a calling and an affinity for identifying deals in capital. So it was then, while still kind of building on my transaction experience technically, that I learned that I was more inclined, just from a personality standpoint, to work with relationships, again, whether it's capital or actual finding deals, that was really kind of where I felt like I was best suited.
Well, we're going to dig deep into that and talk more about it, but maybe we could start with just some background on VRA. Do you mind giving us the pitch for the firm?
So VRA, we are a boutique investment bank headquartered in Atlanta. We are on our 20th year anniversary. Our focus is lower middle market or middle market, depending on who you're talking to. So typically we're advising companies with enterprise values anywhere from 30 to 300, $350 million. The vast majority of those clients are privately held business owners. So, not a private equity fund selling a portfolio company, although occasionally we work in those situations. but the vast majority of our clients are privately held business owners. So think families, founders, owner operators. Most of what we do at VRA is M&A. So the vast majority of our work is representing sellers, although we do also represent buyers occasionally. And then there are some exceptions when we do raise capital, but it's less frequent than the M&A work that we do. It's across 5 main industry verticals: consumer, healthcare, industrial, technology, and business services. Our work takes us all over the U.S. We are 25 investment banking professionals today. The vast majority of those folks are in Atlanta. I happen to sit in Florida. We have bankers in the Northeast and Mountain West as well, but for the most part, everybody's in Atlanta. Typically, we're very focused on a select number of deals each year. So we're closing around 15 or 20 transactions per year. So we're pretty thoughtful on what we take on. It's not a high volume shop. It's intentionally built that way, and it works really well.
That's awesome, man. I mean, look, I feel like the profile for VRA is right in line with what I'd say probably the majority of our audience is trying to engage and target, right? Like a lot of the private equity firms that we know and work with and folks that are listening to this show have this question, which is like, look, Chris, you're a boutique banker. Let's get right to this burning question. Everyone wants to know, what's the secret to engaging boutique bankers, right? Like, what do you care about? Like, how should I, as a PE guy, cover the long tail of investment bankers like VRA?
I think the folks that are really good at covering us are those that are really thoughtful and take the time to really build the relationship. Let's be honest, there's an abundance of capital out there. There's many thousands of managers, quite frankly. So when you're thinking about it from our perspective, we got a lot of alternatives for our clients in most cases. And we can be selective in who we include and do not include in our processes. We're typically, trying to run processes where we're bringing the most relevant, likely buyers, investors to those processes. But I think in terms of how you would cover us, I think it's those that are, trying to make it a reciprocal relationship, quite frankly. So, helping my team on the origination side think about where they are looking for transactions. So bringing us thematic ideas about how to identify prospective clients for us is a really helpful way to build the relationship. I also think those that are going beyond kind of the show me the pipeline, here's what we want to see, and taking the time to get to know us, quite honestly. I mean, much like our clients, it's a relationship portion of the market. So we appreciate those that are really taking the time to build the relationship with us as well. And again, I really go back to reciprocal, like thinking about how they can help us and we can help them. Again, we're not going to always be the ones selling a sponsor-backed portfolio, but maybe we can help you with the buy-side work. Maybe there's intelligence sharing as well. So, what's some relevant information for us to know about certain deals? We use private equity often to help us, think about valuation, value drivers for our prospective clients as we're trying to price those engagements. So those are the types of ways to really help us.
That's really interesting. Yeah, I'm curious, like, how does that play out in your relationships or your interactions? I wonder from like a cadence of interaction standpoint, how often do you want to hear from your counterparts at PE firms? I suppose there's kind of relationships that you want to speak with more frequently than others. But if you were on the other side in a PE firm as a sourcing focused professional and you were trying to build a relationship with VRA or with Chris Reilly, how often would you be in touch?
Initially, when we're starting to build a relationship, I think we're going to spend more time together. And over time, that's probably going to maybe be more frequent, but less time. And what I mean by that is when I'm getting to know a new fund or a new counterpart, a lot of times we're getting to know each other, getting to know the criteria, where they're focused, and vice versa. Who are the bankers at our firm that are covering those sectors where they are interested? And I'm making those connections on behalf of our execution bankers so they can spend more time with that team. I'm giving them access there. And then the relationship, I think over time gets to a point where, you know what, if you happen to call or email Chris and I'm not available, I'm going to be more than willing just to shoot to the pipeline and let you know what's happening. You know how to get to me. So I think on the front end, if you're taking the time to get to know me, my team, and other VRA professionals, over time, I think we can have as frequent contact as you would like, I'd say quarterly is probably the right cadence, although it's more seasonally for, others, like beginning of the year, before the summer, post Labor Day, and then, we're working towards closing things at the end of the year. So probably, the next year. Because typically we're not launching, like there's a seasonality to launching deals for the most part. I mean, every deal is different, but you want to have the attention of all the firms. So we're not going to launch process during Christmas, for example. Right.
Dan mentioned that in our audience, like the area that you spend time, there's a lot of overlap. Folks that we've had on previously, and certainly folks in our network are spending a lot of time in that same segment of the market, lower middle market, and looking for privately owned businesses that haven't received institutional capital. So long way to get to the point, which is there are a lot of buyers out there that I imagine want to be spending time with you. And so I wonder, how do you determine, you can't take calls and spend time with everybody. How do you determine who is worth prioritizing or who can break through?
And I think, there is a capacity to kind of the amount of relationships I can have meaningfully, right? Like I think you can't be one to all. And I'm at the point in my career where I've built a lot of entrenched relationships. Not that I'm not open to new relationships, but that might be building with the next generation of people at the firm, like my colleague Spencer or Ben or other of our mid-level bankers. So when we're thinking about how we, want to spend our time, it's the folks that we know have the ability and track records to getting deals done. They have capital that they can call on, and it's, not a matter of kind of going out and raising it on a deal by deal basis. Not to say that there's anything wrong with doing the independent sponsor model, but we are taking, extra consideration to those types of bidders when they're in our process, just to be transparent. There are certainly those that are very qualified and have that model, and it works really well for them. So, but that's just one nuance in terms of the way we think about who to prioritize time with. And I think those, again, that are bringing us ideas as well, like, hey, have you guys started to look for things here? We're very interested in this sector theme, et cetera. Like, that's super helpful. And more importantly, too, and we'll probably get to this, those that are helping me build relationships with COIs in the M&A ecosystem, where those are our best channels. So the wealth advisors, the attorneys in markets around the country, like that is very welcoming as well. So I love to spend time with people that are trying to be helpful in that way. I feel like I'm in the goodwill business in terms of building relationships, and I would hope the same on the other side of the table with those that we spend the most time with.
So Chris, I was curious to look at the other side of this equation now, right? You're just talking about like how you think about who you're going to spend time with, but let's just take a minute. Like if we were to put you in the seat of business development professional or even partner investment professional at a private equity firm today, right? So you're at this. We start our new deal sorcery firm here, right? Like how do you prioritize out of the 600 to 800 boutique banks out there, like who you should try to focus your time and energy on, because you can't build relationships with everybody. And then like what are the best practices and rituals that you adopt to kind of engage those boutique bankers?
In thinking about that, if I were to stand up kind of a firm, I would hope that it was pretty sector specific, not a generalist. And I'd start with the bankers that are, working within those sectors, and those that have, decent deal volumes. So, I know there's databases that you could subscribe to on the capital side that'll give you that information. So I'd be kind of culling that list down to, those within the sectors we're interested, those that are doing decent volume, those that are working with mostly privately held businesses. So, first institutional transaction. And then from that list, I'd be really trying to intentionally go and spend time and educate them on our criteria and thesis, and look for ways to kind of build the relationship, knowing the execution makers, if they have a coverage team like VRA does, having those names ready to go, knowing the transaction history, so studying up and being informed about what they've worked on, and then helping them think through, like, here's where we see opportunities. And again, I go back to kind of the reciprocal relationship. I think, building the relationship, and that could be outside of work too. It could be, coffee, it could be drinks, it could be golf, it could be any number of things, but getting to know the personal the person on a personal basis to really kind of have those nuggets of information when you check in not only on the business, but how are the kids and all the other things that are going to just really increase your attachment to that relationship. I actually really happen to like the novel kind of promotional gifts, which I think kind of seem on one hand like chintzy. I don't know if that's the right word for it, but on the other hand, like I have a number of things that I like. Like I just received this basketball hoop from somebody and it sits on my door and it's a very memorable thing. Like I see that, and I got a great water bottle 2 years ago. And I don't know why I attach these things, but like those are useful. I mean, some of it's not useful, but like the good gifts are, very nominal, but like it etches it in your brain and it really sticks with you. So I think those can be kind of good ways to kind of attach yourself to those relationships.
So it sounds like the tactics you'd be going after is, so like for after down selecting, right? Like, here's the folks that I want to go after, right? Like you'd be working on like high quality novel gifts, promotional gifts. But then it sounded like the second thing I really heard was like, be human, like, remember the personal points about them, their kids, their story, their interests, that sort. Is that right? Or like what's that full set of tactics you'd be deploying?
I think that's right. Like, because like you don't want to be super transactional, particularly in the lower middle market. Again, where if you think about the makeup of our firm, where we have chosen to work at this end of the market, our bankers many of them have come down market over their careers from bulge banks and choose to work in the lower middle market because that's where they feel it's most rewarding. And we work with those business owners because we're making a big impact in their lives. And it's typically the most meaningful transaction financial transaction they'll ever make. So there's a lot of education, hand-holding. There's a lot of gratification from our side when things get done and they're really excited and happy with the outcome. And I'd say if you kind of think about why we're doing the work we do, you got to kind of tap into that side of our work. And that's the way I would try to build a relationship, right? Like it just can't be super transactional. Show me the pipeline, give me the teaser, we're going to bid. Like, okay, great. There's plenty of money out there. Everybody's selling money. But I think those that are breaking through like that are going to do better generally.
So you kind of just talked us through how you would do it. Maybe, in other words, the right way to engage the boutique investment banking community. Are there just kind of common pitfalls that you see firms come into? Like, obviously not asking you to name names, but things that people should try to avoid that tend to happen maybe more often than you'd hope?
I mean, yeah, I think it's just rigidity of like, hey, getting straight to what do you guys have and what are you bringing out to market? And it's almost as if they don't know that we subscribe to all the databases. So we have, 20-year history and longer, beyond VRA, but all the other, relationships that our firm has built over their careers. We are going to all the conferences for the most part. Selectively, we generally know. Now, there is certainly outliers where a new fund's coming on. They've spun out of a large fund and they're standing up their new fund. So it maybe is not on our radar just yet. I think, the ones that are coming and just, again, it's just very transactional. I don't know how else to say it. That to me is fine. Like, I don't mind including you on the list, but it's just not going to leave that much of an impact. So when there is the chance that there is a more narrow process, which is, I think, the ultimate goal, that, maybe there's some situation where it doesn't warrant a large, broad auction, and we're being selective about trying to introduce only a few counterparties because there's more of a story to the asset. That's going to lend itself on the margin to those relationships that we know and trust and build, and they're going to, treat our client with white gloves versus, something that is more transactional, less memorable. So I'm not going to think about you in those situations. Or more importantly, maybe there's a buy side situation where we're not engaged and we're just pointing them to a potential add-on or something that it's not a mandate for us. Like, you're less likely to get that one-off call when it's just transactional.
So what's it take today to be included in that short list or fireside chat sort of approach? Like some people have said to me, oh my gosh, I feel like today what I have to do is I kind of have to begin the pre-work on a deal like 6 months before it's kind of coming to market in order for me to kind of be in the short list for a small chat like that. But that also seems overly aggressive, right? Like that'd be the requirement in order to be there. But like, I don't know, is it just demonstrating intent and showing that we've done a little work in this space and we're seriously interested in it, and then showing a little bit of personal interest in building a connection? Or like what's the set of things that you'd be doing?
I think those things that you mentioned, I think it's, certainly, on a preliminary basis, probably tuning the bar within the range of reasonableness from a value and an outcome perspective, or at least giving some sort of indication there. Knowing the asset, I think, is probably going to help as well. So some existing relationship with management probably is going to help. And, again, respecting our engagement and not going around us and trying to work through the right channels when there is an opportunity to have such a meeting. I think that is going to really put you in a good position to potentially have that meeting.
Shifting gears slightly here for a second, when we think about what do you track? You're mentioning we subscribe to databases, we have data points on private equity firms. What are the KPIs you're tracking against the different buyers out there that kind of show you signal about whether they're a good buyer or somebody we should include, or a number of times we've given them an at bat and they've come back? What are the things you're tracking?
Bid history is certainly going to weigh in on the way we think about it. And I think, those that have behaved maybe inappropriately in a process for whatever reason, there's certainly going to be consideration on our side as to, how to handle them in the next process. So we're thinking about that when it comes to advising our clients, right? Like, they behaved this way previously. Not to say your asset is the same, no business is the same, but this is a consideration and, a part of their history in terms of buyer behavior and patterns. So I think, those that are putting a meaningful foot forward and sticking to the value and having done the work and showing us that they've done the work is going to matter in our consideration as well.
There's a couple things I feel like I'm pulling out of that, right? One is having that quick no, right? Be the second best answer, right? And then kind of sticking to the value that you'd put on the table early on, and then kind of showing you've done work in the space. Is that right? Or are there other things that you're looking at in terms of bid history?
No, that's right. I think so. A quick no is certainly helpful. Look, you're going to meet management and that may change your opinion and assessment, but I think we try to present our clients in the best light as we can, and kind of that includes good and bad, and we're highlighting that within the materials that we publish. And if you're not paying attention to what's in there, which can happen, I think we're going to note that. This was said in the book, not being detailed, if you will, in that regard. I think that can hurt you.
Let's flip the lens again for another minute, and let's look at your origination function, right? So your guys outbound, you're reaching out and engaging, business owners directly, right? That you guys are looking to represent. Are you reaching out to private equity firms at all? Or when you think about your origination function, who are the sets of folks that you're reaching out to?
We have, I'd say, three main channels, and there's a fourth, and I'll get to that. But three main channels my team focuses on. My team is a team of three, which again is unique for a boutique of our size and scale.
Totally.
It's an important differentiator, and I think it really allows our execution professionals to deliver the highest quality service on each and every engagement. So that's a little bit of the secret sauce, if you will. But we are focused on three main channels as an origination team. The primary channel is that of referral sources. So that's anybody in and around the M&A ecosystem interacting with the business owner. That could be the wealth advisor, the attorney, accounting, insurance, consultants, whomever is interacting with the business owner that could be referring us into that situation is really a primary focus. And within that referral source category, I'd say we have some key strategic partnerships that we really focus on, and I'll get back to that. But the second channel my team focuses on is kind of sponsored coverage. So that's, all the middle market, lower middle market, private equity funds, independent sponsors too, to a lesser degree, but that cohort of capital, and it could be debt capital too, junior capital, mezz, whatever it may be, that is a secondary focus. And that's for two reasons. I mean, first and foremost, we are gathering intelligence. Our team uses that intelligence to understand what's happening in the market, how capital perceives valuations, value drivers, what's in their portfolios, what's growing. All that is helpful to our dialogue with business owners and then prospective clients and clients. So that's the main focus within the sponsor coverage responsibilities we have. But also we are and have a growing buy side practice too. So we are going to them for situations where they're looking to grow. Typically, their platforms through M&A. We would consider platform searches occasionally. We have not candidly done one, but we would consider it in the right circumstances. But we are working with sponsors now more than we had in the past. Typically, our buy side work had been predominantly with corporate, in some cases publicly traded or just large privately held businesses that are growing through programmatic M&A. Now we're doing that more with sponsors. The last channel is what I'd call our direct channel, and that is calling directly on business owners, typically where we're chasing our success in closed transactions. So we close a deal in a certain sector, we're calling a list, we're identifying business owners that are yet to be or yet to have taken on an institutional partner. So they're not owned by a private equity or some corporate, and they might be good targets for us to help on the sell side. So we're calling on those business owners directly. That playbook is the same when we're retained on the buy side too. So our direct effort is, it's a mix of voice, digital mail, and direct mail in some cases to prospects. Again, could be retained, could be just chasing our success on the sell side. So those are the three main channels. The fourth channel, which my team doesn't spend a lot of time on, is that of former clients. So our execution bankers have those entrenched relationships after closing a transaction. They're doing a lot of interacting with their former clients, which is a great channel for our firm. So those are the four channels. But my team spends the vast majority of our time in the referral source category.
I think I've heard you also say kind of like centers of influence or COI. Is that what COI stands for when you talk about that?
Obviously, yeah.
Yeah. So referral sources, centers of influence, right? Like that's the wealth advisors, attorneys, insurance, all that sort of stuff, right?
Yeah.
Yeah. And then the three main channels for you, like you said, referral sources, sponsor coverage, direct to business owners. Do you track KPIs across those different channels? Like, are they the same? Are they different? And like, what are you, is there leading and lagging stuff? I just love to dive into the metrics for each one of those three.
So I'd say yes is the answer. The leading metrics, if you will, at a very high level, it's market visits and interactions. We're tracking how often we're in certain markets. So like I said, our clients are nationwide. So my team is getting out in the field and going to certain markets where we have an abundance and a density of referral relationships, and then we're building around that. So the prioritization of our market visits is typically key referral relationships, secondarily kind of sponsors, and then direct as well. So that's how we prioritize. So that would be one metric we track, and we know kind of how much we're out in the field. And generally over the course of a year, for the most part, every other week, it comes in seasonal kind of waves. So like I'm very busy traveling, as is my team, late January through up until Memorial Day, kind of tapers a little bit in the summer. And then you're back at it Labor Day through kind of Thanksgiving, if you will. But that on average is, every other week, a little bit more than that. So that's one metric. The other metric is really, it's shots on goal. It's pitches, right? So we're measuring how often we're getting to pitch a business. So that's a key indicator that we track, what we're winning, what we're losing. The best metric of all, which is a lagging metric, is revenue, right? Like we're based and that's the best metric to measure, how we're doing, right? Is what kind of revenue have you brought in? Where do you have attachment to certain engagements and what you're doing? And, part of what we do is in marketing. There's a marketing element to having awareness about the firm and being out there. Really is a heavy sales type role and function, though, more so.
So you break the world up kind of geographically, and you think about like visits to like tier 1 or tier 2 cities or cities that you've prioritized. Is that how you do it?
Yeah, that's right. So there's a density. If we have a good reason to be in a market, and we know, key markets, Dallas, Tampa, New York, Chicago, those markets where we have a density of COI or referral relationships, like those are our key focus. And then there's secondary markets where we will also go, but maybe not as much as a priority. I wouldn't say we have you must be in this city every quarter. We have those types of goals because sometimes we'll anchor on an event that might come up. We know certain conferences, we don't attend all the conferences on the ACG circuit, for example. We have select ones that we like to go to, but then there might be a PEIB deal meeting. Like the one-on-ones that are set up by a lot of law firms are a great way to get into market, have a density of meetings with sponsors, and then build around that our referral relationships, and then also direct relationships as well, to the extent, folks are willing. So it's really about trying to think thoughtfully about the ROI on the marketing dollars that we're spending, and getting a density of meetings. And look, there's some meetings where, you might be a heat-seeking missile and going in for like one very key meeting, and that's all you really need. But if you can build around that, then clearly it's going to be a good, or we would think it would be a good ROI.
It sounds like in general, so you're looking at geographically, you're kind of saying where's there's density of kind of use your term, right? Density of centers of influence, right? Are you then also cross-sectionalizing that against like industry or end market?
Not so much, I wouldn't say, because our firm, because we're in 5 main verticals, which it's pretty generalist approach as a firm. So consumer, healthcare, tech, business services, industrial. I wouldn't say we're prioritizing it by sector like that.
Okay.
We're not cutting it up that way. No.
But then it's kind of like tier 1 or tier 2 cities that have a density of wealth advisors, attorneys, insurance, sort of folks that we could go visit, right? And then prioritize those set of cities. And then do you build out like a pipeline by channel, right? In terms of like, okay, here's wealth advisors we've never engaged. Here's wealth advisors, we've reached out to. Here's wealth advisors that we've had a conversation with and met. I don't know. Like, do you break out different pipelines across these different channels?
Yeah, I think there's definitely a consideration with those wealth advisors, particularly, or attorneys that have been frequent referral sources. So they're sending us opportunities and engagement. So those are firms that we know. They know our firm. They know the work we do, the quality that we provide, and then trying to be good partners. Like I said before, like building goodwill with them, and it's bringing them ideas. And I'd say with the wealth advisors and attorneys too, a lot of what we're doing is we're taking the outreach that we do around the market. So when we go to a market tactically, like I said, we'll anchor on those key relationships. And then I'll build a calling list around business owners in that geography that fall within certain, parameters, whether it's employee headcount, non-institutionally owned, certain sector maybe that we see as particularly active. And that list, we'll do outreach, but then I'll also take that list and I'll share it as a goodwill gesture with referral sources and say, hey, do you happen to know these folks? And if you don't, you should probably call them. This looks like a great business. And they love those ideas. So that could work in terms of, me helping and trying to build a relationship, and my team doing that as well, I think is pretty welcome. So that's a little bit of how we try to be good partners.
Let's double click into a little bit further into the referral sources. You mentioned the different types, but I'm curious like how this functionally works. Like how do wealth platforms route opportunities, down market to trusted banks? Like I think you've mentioned before, working with bigger banks that maybe do the same thing. So maybe you could just kind of educate the audience, and us on how this part of the market operates.
Sure. Yeah. So one of the key focuses that I have and my team has is working with our strategic referral partners. And that could be larger, financial institutions that have investment banking capabilities and don't have necessarily capabilities kind of in the lower middle market or middle market. It could be a commercial bank that just doesn't have any investment banking capabilities. And then it could also be just a larger investment bank that has a threshold for deals that are above market for us. So those referrals for most of those circumstances come in 2 directions. In one case, there's a centralized network that is organizing and playing quarterback essentially on referrals internally and trying to route them to the right teams. And then there's a checklist. And once it's, not a fit internally, perhaps then it gets kicked to a network of partners. So that's one kind of way we can kind of receive things. Another way would be just having the built-in relationships with the field. And that could be the commercial bankers or wealth advisors in the field that are originating those opportunities, sending them to a centralized function, and then it getting kicked back. Well, sometimes they can come directly from the field because we have these longstanding built-in relationships, and they just know that we're a qualified partner and they have, refine their internal and metrics and criteria enough to where they know it won't fit internally. So they're just calling us directly. So that's two ways, like from a centralized kind of function or directly from the field. And I'd say where we try to separate ourselves as one of these types of referral partners is being out in the field, investing the time with the relationships that make us in a good position to get that call. My team, myself included, Spencer, Ben, will be out in market and we'll be talking about, again, our activity, where we see, certain trends, and just that constant connectivity with the relationship directly often yields a quick call from the field versus something getting routed through a centralized function that maybe gets pretty competitive.
Chris, it's really interesting, like diving into these referral sources some more and these kind of centers of influence. Like, can you give us just like a real example? Again, doesn't need to be the name of somebody, but I'm curious, like, to walk through the evolution of a relationship, right? Like somebody maybe you reached out to, you met for the first time. Like, how did you build that relationship? Like, what are the gives and takes? Like, what are you showing up with in the way of value? Like, I'd love to hear a real world example of something like that.
The one that I was thinking of in particular was one where we were doing our work as a good partner and kind of being out in the field and educating our partners about the middle market, M&A, giving kind of the firm commercial, picking up the phone when people had questions about a transaction or a certain situation. And in this one scenario, I happened to go deliver this commercial, if you will. And I got a call about a month later from a gentleman who I don't even remember meeting and had just kind of dropped business cards. And he said, I think you were in our office, about a month ago. I have a business owner I'm working with, would you be willing to talk to them? And we said, of course. So we got connected with the business owner. That conversation went well. We got on our plane, we flew down, and we were hired on the spot. And that turned out to be one of the larger transactions that I've ever sourced. And that was just from a one-off situation, if you will, not a long-term build, but that was a really, it's a testament to kind of just being out there and being in the field.
Was that a wealth manager? Like what type of referral source was it?
He was a wealth manager. Yeah, as wealth manager, he had worked with the business owner for well north of, I think, a decade. So long-standing relationship, knew that they were inclined to pursue a sale for personal reasons and just lifestyle, generally kind of had built a great business, was looking to step away and reap the rewards of what they had built. And that was from a wealth advisor. And mind you, some of these wealth advisors that we have relationships with, there are referral incentives. So there's a rev share on that he was privy to. But the real opportunity for them was the AUM capture, which was substantial. So that, dwarfed the actual, portion of our fee that he was able to share with us. But the real opportunity was the large. It was probably north of $200 million deal. So
just to tactically understand how this works for everybody, right? So like the point being that like you've got a wealth manager, and the wealth manager, works with a business owner, and the business owner is thinking about like what to do with their assets. And when they think about a transaction with their business, then there can be more cash that's under management for that wealth manager. So it's beneficial for them to see a successful transaction if they can help that happen, right?
Correct. 100%.
And then the second part of it was you were talking about like the rev share. Can you just click into that so we kind of understand what we're talking about?
Our banking engagements are very typical for a boutique investment bank like us. It's all success fee driven with the exception of a retainer upfront. With the strategic partnerships, they share in a percentage of the success fee on a one-time basis.
Got it. So when you worked with that wealth manager, for instance, right, like you had an agreement with them that like, hey, if you bring us an opportunity and we end up putting a deal together and we get a success fee at the end of that, you're going to get a percentage of that success fee.
Correct.
Is that right?
Correct. There's an alignment of interest there for sure. And that's a transparent disclosure in our engagement letters when we sign with the client. So they're well aware that a portion of our fee is going to go to the advisor. So again, there's alignment there. And I think, for wealth advisors too, a lot of times if they are working with business owners and the situation presents itself, it's better to be kind of bringing your investment bank to the table, because chances are if another investment bank is representing that business owner, they're probably bringing their internal wealth capabilities, which may put not only the assets that are generated through the sale at risk, but also any kind of current assets. So it's a real defensive tactic, I think, for the wealth advisor to kind of work with a partner that's, aligned and qualified too, because there's an abundance of folks out there that play kind of investment banker and they're not licensed. And I'm not just trying to disparage any certain types, but there's definitely folks out there that are not as qualified. And part of the reason I think some of these partners have qualified lower middle market or middle market investment banks is so that their FAs don't have to think about, how to, really go through that hassle or help their business owners thinking about that, right?
I'm curious, from your perspective, are wealth managers or other COIs already building relationships broadly with a lot of different investment banks or maybe PE firms? Or is this like still pretty underdeveloped, untapped?
No, I think there are certain groups that are definitely more sophisticated, right? There's definitely an element of highly sophisticated kind of private wealth or ultra high net worth wealth advisors that have and manage accounts with folks that have likely generated large sums of liquidity because they sold a business. So they understand kind of what we do and how that relates to their business. And then there's more, I'd say, retail oriented folks that probably work with business owners that don't come across those situations every day. So they're not easily identified as maybe the private wealth type. But I think more and more there is an education out there because I see more and more platforms that have at least some sort of functionality where they're helping those, advisors with the business owners, which makes a lot of sense, right? If you talk about the silver tsunami and the abundance of wealth out there with, the boomer generation and how those businesses are expected to transition over time, I think the FAs are going to be likely one of the best relationships and influencers to kind of bring in a banking professional. So more and more, I think there is an education about that because they want to capture that wealth. They want to keep it managed and they don't want to see it, move away to another institution. So I think it's growing, but not everyone they're not all created equal.
Totally. Yeah. It feels, just from my seat, as I speak to a range of people that are on the PE side doing sourcing, it seems like it's underutilized or not an area where a lot of people spend time. And maybe that's just a bandwidth issue, because if you're covering, what Dan said earlier, 600 investment bankers, right? Throw in thousands of private wealth advisors, in addition to other centers of influence, like that's a lot for even a team to take on.
When I think about this, there's probably a graphic to create here, but there's a food chain of M&A. And I think, it makes a lot of sense that private equity, it's a lot more efficient to them to come through intermediaries like an investment bank or broker. It's a lot more efficient for us to source through COIs and referral sources, particularly for privately held businesses, from those that are already having those entrenched relationships. So, tactically, like bringing on more strategic partners just gives us much better breadth and depth of coverage versus going direct, which is important, but it's a much higher volume, lower hit rate game versus, going to somebody that's already has an established relationship.
What would you say makes a referral source relationship durable over the years? I imagine that there's many where opportunities don't lead to engagements, but you still cultivate that relationship, keep in touch. Like, is there a secret for doing that well?
The ones that are willing to put in time and educate themselves. And I love getting inbound calls from those types of relationships asking me, Chris, Spencer, my team, what do you think about this? And a lot of times it's a quick no, but like helping them kind of refine the way they hunt. So I'm empowering them. Those are great relationships to have. Just like the counterpart on the capital side with the sponsor coverage, it's a goodwill kind of relationship exercise. Like, are they trying to be helpful by bringing and showing us stuff? And then also, do they understand that while I think we are in a position occasionally to kind of make referrals to clients, it's very infrequent. And the reason for that is the way our model is set up. Again, it's low volume. A lot of times our relationships are coming through COI, so we're not going to try to displace them by introducing somebody else. So really kind of understanding that dynamic and knowing that we're going to try to help. Maybe it's not a direct, wealth capture opportunity, We certainly do those again when we can, but that goodwill kind of exercise, reciprocal relationship, I think is going to make it more meaningful, just like I mentioned on the private equity sponsor coverage side.
I mean, it makes a ton of sense, right? The more you're talking about it, it's just this like symbiotic, mutually beneficial relationship. You're both out there hunting in the universe, but you can kind of both help each other, right? And bounce ideas off of like, what if we go after this area? What if we go after that area? And have you thought about trying this? And hey, what do you think how I should try that, right? Like makes a ton of sense, especially as we've been talking about, like the wealth manager side of the equation. I'm curious, as you think about some of the other COIs, because we haven't really touched on, like you mentioned attorneys, insurance, consultants, all this sort of stuff. Maybe just to like double click on one of those for a minute. Like for attorneys, what does your market intel or experience show in terms of what they actually care about? Like, is that different than what the wealth folks care about? And like, how do you build and manage those sort of relationships?
Yeah, the attorneys are great advocates for us as well, particularly the M&A folks specifically, as well as the corporate, folks that are focused on the day-to-day client relation. But the M&A attorneys, I think, are great because they know, I think the likelihood of a transaction closing is much higher when there's an advisor working with the business owner and they've made the investment, working with somebody like ourselves to kind of bring that transaction to a close. So thereby, helps them. I find it very productive to spend time with them. And again, it goes back to the normal cadence of what we're doing. It's educating them on what we're seeing, what we're working on, and then, understanding what they too are doing, because there are certain circumstances where we are referring, I'd say more than wealth, probably attorneys, where there's an incumbent, and while that incumbent attorney is fine, they've just maybe worked with them for a long time over the life cycle of the business. They set it up, they did the corporate work, or they do the corporate work now, but like they're really not experts at M&A, and they don't have an M&A team internally, and that can really diminish the likelihood of a successful outcome if you don't have an expert in M&A on the legal side. So I think we're able to really help our clients and convince our clients to work with somebody that has that skill set. It's not every situation. And look, certainly there's a lot of situations where there's like, well, they were working with an attorney or a law firm and we're like, they're great. You need not do anything there. We're terrific. We love working alongside that firm. So that's how we work with the attorney relationships. I'd say like on the insurance side, it's probably a little bit more of the lead sharing that I talked about earlier. So we're calling our list of direct company outreach in a certain market. I'm going to Dallas as an example, and I've got a list of 100 businesses that we think are good targets to do outreach. Are you calling on them? And, on the one hand, they may say, I know 30 of those, but I didn't know these other 70. So that's great. I love that intel. And I'm going to call on these businesses because I'm feet on the street in this market, and we're going to be 1 degree away from that person, whereas I'm probably 2 or 3 degrees away from them. That's how we work with like insurance. Accounting, I feel like directionally we're sending a lot of stuff to them typically, particularly QV work, because it's almost without exception that we recommend most of our clients get QV work done. Accounting can be helpful too. I'd say, they'd be in that second bucket as far as a tier of referral source, whereas wealth and legal are kind of that tier 1. I put them kind of tier 2 as a focus. But there are some great accounting relationships that we have that are great referral sources too. Now, some accounting firms also have investment banking capabilities internally too. So you just got to kind of think about that when interacting with them.
Chris, you've been out here, banking as a boutique investment banker for 10 plus years now. What do lower middle market and middle market kind of processes look like today? And how has that changed over the course of the last decade?
Processes today, I definitely think in this market are taking longer, just given a lot of the uncertainties that you're well aware of. And it's certainly not like it was in 21 and early 22. There's definitely been more of a shift over my time to more specialized, I think, type funds where they're, focused on a handful of sectors versus the generalist approach, which I think is just more thoughtful. And, the value creation is more through really extensive work and research and knowledge in a certain sector and area, whether it's like connectivity with the right executives, understanding, big relationships in that world versus just like pure financial leverage or engineering, if you will. So those are the kind of main things that I've seen, I'd say, change over the time I've been here.
Yeah, it seems like one of the big changes like in that time period is like the growth in private equity, like the number of funds, the number of buyers out there, right? And the way I understand it is because of that, or as a result of that, coveting relationships with bankers has become more of something you have to do on your front foot and be more intentional about, as opposed to maybe, in the past, as one of fewer buyers, you could be a bit more reactive and deals might come to you. So I'm curious your take on that, if you see it the same way.
Your podcast is a testament to kind of where it's gone in terms of like the function has dramatically changed on the capital side from the sourcing perspective. I see the BD professional has gotten a lot more sophisticated since I joined the firm. And what I mean by that is they're not just teaser gatherers. They're really thoughtful. They come from execution, whether it's banking or just PE, deal work, and really, really know the criteria well, can articulate the message very well. And that's certainly welcome on our side, because I think it's a lot easier to kind of, qualify them versus the teaser gatherer or taker or whatever you want to call it, and just kind of, lobbing over offer and not having a lot of thought or detail behind that. It's just gotten a lot more efficient, I'd say. I do think too, there's an abundance of managers out there, and capital, what's real and not is can be confusing, I think, for some of our business owner clients who are getting approached by, committed funds and, independent sponsors that, don't have the capital. And there's a big difference between the two. Not to say, one can't work and the other can. Both can work, but I think it is a little confusing to folks. So the proliferation of the amount of people out there trying to provide capital is definitely grown. And I think there's probably a reckoning at some point. Maybe not the amount of capital, but the amount of managers out there.
Yeah. Yeah. As a product of what you just laid out, something that comes up frequently in our interactions is M&A events, conferences are much more crowded, right? And they're great, efficient ways to meet with bankers, right? And do it all in one place. Curious how you prioritize your time when you go to an M&A event and you decide who to meet with, and how PE firms that are trying to meet with you should think about that.
Our approach is it's selective. We do a handful of these each year. The ACG is probably the best one to use. We definitely attend Atlanta, M&A South. We do DealMax. We do Florida. We do other kind of key markets. And then, occasionally some of the other one-off events. My time is spent, candidly, a lot of times with existing relationships that I want to see in person that I've established. So given where I'm at in the arc of my career, I'm probably on balance spending more time with those, and then also trying to, establish new relationships as well, but more with existing relationships that I just want to go deeper with. Whereas somebody like my colleague Spencer is probably still building a lot of those relationships with his, age cohort, if you will. And same with Ben. So like they're doing more of the de novo new, and I'm kind of working the existing with a mix of new as well myself. That's generally directionally how I spend my time, because I know I can, go pretty deep quickly with them, and it's a good use of my time.
Chris, we didn't talk that much about proprietary sourcing. And I know that that's something that your team does for potential sell sides or on behalf of buy side clients. Someone told me recently that it's actually harder to engage directly with business owners as a banker than as a buyer. And I'm curious if you agree with that. I think the point was saying yes to running a process is a bigger task to take on than a one-off conversation with a buyer.
Yeah, I think that's mostly correct. I think from what we've experienced on the buy side, when you're coming with a very thoughtful message about how you can partner and provide capital and why it's important and how you can grow together, and you're hitting on all those pieces, I do think that is generally like a higher response rate for the most part. And sometimes they know the player too. So when we're doing the buy side work, the client is often known to the target potentially, whereas when we're doing the direct outreach on the sell side or chasing our success on the sell side to folks, we're typically using a transaction. So chances are they probably know the transaction. So that's part of the hook. But I would say it's a lower hit rate generally. I will say, interestingly, though, where we see higher hit rates is when we go to market, and it might even not be under like we're trying to reach out to the target with, hey, we just closed this deal in a certain sector. We'd love to share that intel with you, whatever we kind of message. But I'll be in Dallas and I'd love to stop by and see you. And people are like, sure. So like those response rates to that message versus the, hey, let's get on a phone call and talk about a transaction. We receive, I think, higher response rates to that in-person meeting, which is a testament to being in person. Back to your question, the private equity and having capital ready to go is generally a higher hit rate for the most part. Although we're trying to convince them we're their advocates, and there's likely a bevy of options out there for them to consider. So we just have to educate them on that, and they're not always understanding that. So
great. Well, Chris, it's been a really fun time having this conversation with you. We really appreciate you coming on, and we look forward to doing it again sometime.
Yeah, I really appreciate it. Thank you so much for spending time with me, and happy to answer any other questions, but really appreciate it, Dan and Matt. Thank you so much.